Investors have gotten a taste of what Donald Trump's return to the White House might mean for the markets, global trade, and international relations. Our chief equity strategist and economist, John Blank, back with me now to help explain a few things. John, investors were counting on a solid 2025 for U.S. corporate profits to boost stocks. Q4 earnings season got off to a great start. It's been progressing rather well, but there's been analyst speculation that this time around, earnings may take a back seat to President Trump's return to the White House and that slew of executive orders. Do you see it that way?
Well, Terry, this is what we got to grant this president with his business and negotiations background. Some credibility might be the right word, actually. He likes to create attention around certain issues by using tariffing and other executive orders to threaten not only allies, but people who are not allies, basically anybody. And that does actually seem to bring around some new actions by the players who are threatened. For example, Mexico really did find a fentanyl tunnel. Canada really did put up drones. There really was a discussion with Colombia about the overflights. And this is often confused as a standard tariff war, where, in fact, it's a more tactical negotiating tactic that the president has deployed. And, I think, it's not massively successful, but it has more credibility than people give it credit for.
So will his policies be a market driver going forward?
I don't think so, Terry. I don't know you can go to the well very often this way without starting to create more long-term implications. But I think to start your term, there is a certain amount of inertia that is disrupted and a certain amount of tension that's provided. So I do think on a one-off basis, he is gaining some traction with this tactic. I really have much greater reservations, if it goes on for the entire year.
Is that basically the same situation with any impact to the economy?
Yes, it is, Terry. I mean, if we look at the most credible assessment of the U.S. economy, which I think is the Federal Reserve and their latest summary of economic projections, they broad core PCE, which includes food and energy, Terry, in particular food prices, which can and are volatile. They actually have it rising, broad core PCE rising in 2025 because of food prices and the effect of the immigration and tariffing. So that is actually what the Federal Reserve System in their economic projections, that is not my projections. That is what they project. And I think that is also accurate. There is going to be a tick up in broad PCE, which the Fed does not track, by the way. It does not affect monetary policy, but it does indicate where the pressure will be, which actually could be in our food prices.
As high as stocks are right now, do they still have more room to run?
Well, Terry, there's been two major waves of advancement in valuations in the U.S. economy since COVID ended. The first was the mega caps and tech generally. The Qs, are probably the best example of that, ticker QQQ. We all know that story, and we still know that story plays out with strong growth in tech, and it's a dominant player in the market weight S&P 500. The next wave came when the Fed started cutting rates back in September. Now, several months ago, which was the major banks got a lift because they had loans out and then they were getting deposits in at a lower rate. So they actually had a profit tick up along with the wealth management groups. So now we're in for the third wave of what can support this market going forward. And if we listen to Shiraz Mian, he says all 16 sectors are showing some broad-based growth, and a number of them are double digits. So it may well be that, we just get a broadening, continuing on with the tech boom, but a broadening from it as its implementation as CapEx kind of reach into the economy and consumer discretionary and other areas.
Globally, European policymakers are getting higher borrowing costs and soaring energy prices. What's the story there?
Well, you have to be careful. Again, those are the volatility stories, and they're tied to the Ukrainian situation. And I think you really have to hesitate to read anything into volatility like that.
At the Davos Global Summit, which we just had a short time ago, War was identified as the main risk for 2025. Would that be a market risk or an economic risk?
Well, Terry, they're referencing two theaters, which is the Ukrainian theater with Russia and the Taiwanese theater with China. In truth, the Israeli situation is in a tentative truce, so that's actually gotten better. We have a regime in Syria that is no longer Assad related for the first time in half a century, which is a positive. So the war discussion also needs to be considered a more mixed discussion than just a uniformly negative discussion, because the flurry activity just in front of the inaugural did in fact lead to some positive changes again. Again, nobody likes to credit the transition of power, or they overcredit one or the other depending on their politics. But again, we're actually, from a war theater perspective, in a mixed environment because there has been some success, albeit tentative.
What do you make of the global market response to President Trump's remarks at Davos, where he called for lower interest rates?
I think the Federal Reserve is under a statutory mandate, and I would prefer the traditional approach to monetary management to hold forth. And I think, hopefully that will be just more jawboning that gets ignored.
We touch on this every year. You expect any January impact for stocks in the market?
Well, we had a good January, Terry, and actually a good January in Europe in particular. Again, nobody would have expected that. But in general, if the January effect is credible, we're looking at a decent returns year for stocks, not only U.S. but non-U.S.
All right. Speaking of stocks, three very large cap number one ranked stocks on your radar include Wells Fargo, ServiceNow, and Qualcomm.
Yeah, let's talk about Wells Fargo. I've got a price at $79 a share and a target price of $90. Amongst the major banks, the only one with a value score that's attractive, they have a value score of B. So you want to look at Wells Fargo as a value play in a bank situation that's pretty much fully priced. ServiceNow, ticker NOW, value score of F, Terry. This is where you have a terrible value score because the growth is B, and then the DAX rank is number one. So here we got a classic situation. Momentum score is A. Of course, people are trading this up on the growth story, but they've driven it up to a value score of F, and the forward price earning rate is 62. So I don't like ServiceNow. I think it's going to get sold on profit taking, and I would avoid it. Number three is Qualcomm, which I actually think is the most attractive of the three. We've been at a target price of 189. It's at 172 right now, and we can run all the way up to 220, which we saw last year, because they have the Snapdragon chips, and they've actually been called out to maybe perhaps purchase Intel. They're certainly AI-type chips, these Snapdragon chips. So there is an AI play with Qualcomm at the chip level, which people should know about. And it actually isn't overvalued. I got a PE here of 15.3.
Our chief equity strategist and economist, John Blank, on earnings, stocks, and more. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.